Hey all, welcome to ShareTrek. This is Raj here. Friends, if you recollect, a few days ago I had published a video titled Recession, Stagflation, Where to Invest. I had published part 1 and I promised to you that I was going to come back with a list of ETFs that can be useful in not only recession but also during stagflation. So I have the comprehensive list out here and I'm going to present that to you in this video. So sit back, relax and enjoy. Let's get started. Welcome back, friends. The first set of ETFs I have is from the defensive sector, and these are recession-proof stocks inside the ETF. The first one is XLV, Healthcare Select Sector SPDR ETF, and healthcare is most essential regardless of the state of the economy. People need healthcare to live. Life is the most precious thing, and at the Maslow's theory of hierarchy, it's at the very bottom of the pyramid, and it's the most essential thing apart from food and shelter. Next, I have XLP, Consumer Staples, and it consists of companies like Walmart, Coca-Cola, Procter & Gamble. These are companies which sell essentials. And I would like to qualify that Walmart, I believe, would behave differently when it comes to recession because they have control over their product mix and they may sell less of expensive discretionary goods and more of essential staples like milk, eggs and grocery stuff when it comes to recession, and that's why I think they are a good company to be involved in the XLP ETF. So overall, XLP should be another defensive sector for you. Vanguard Utilities ETF is another area of essentials which will continue to be purchased even during recession, and that's because everyone needs electricity, water and gas for any typical home in most of the places that we live in, unless you are living in some kind of a jungle or something away from the civilization, off the grid. But electricity, water and gas, VPU will take care of you during a recession. And then of course we have got VIG, Vanguard Dividend Appreciation ETF, which invests in strong dividend paying companies that perform well during downturns. So they have already done the homework for you. So these are the ETFs that I came up with. And again, friends, I want to make it very clear to you, I'm not a financial advisor. I don't have accreditation to recommend ETFs. So I'm not recommending these ETFs to you. I'm sharing my findings because as a retail investor, right now, I'm doing my research to find out what are the places where I can shelter my portfolio in the event of a recession or a stagflation, which is what Jerome Powell was talking about when he spoke last. He was saying that he's watching the inflation. He was saying that he's watching the employment levels, and we know that inflation has not gone down and employment level is going down. So when we have low employment and higher inflation, it is stagflation. So that possibility also remains. That's why I made this video. So please keep that in mind. Before you buy any of these ETFs, do your own investigation. I don't want you to end up buying blindly because I said so and then feeling cheated because it did not perform well, because every investment has got its own inherent risk. And remember, we are going through an industrial revolution which is called AI, and that can distort the future when you try to compare it with the past. So that potential is always there. So keep that in mind. Next, I want to talk to you about bond ETF, which is again something that investors use to fly to safety in case of distress. Recession is a distress event. So that's where most investors will go to save value in their portfolio. TLT, which is iShares ETF, it contains 20+ year treasury bonds. And when the interest rates drop, the face value of the bonds go up. Therefore, TLT will see improvement in the value. It will improve in its face value. And therefore, it's a good place to be in because you get your returns and also capital gains. But one has to be careful and dispose of TLT when the recovery starts, because when the recovery starts, TLT will start going down because the interest rate will start going up and the face value of the, and the market price of the bonds will start going down. And therefore, you have to remember that once you buy TLT, it's not like buy it and forget it. You have to keep track of what's happening with the interest rates, and as the interest rates start rising, you should take a decision to sell off the TLT and take your money and put it into growth sector, which are going to gather more value as the recovery picks up. And then we have IEF, which is the iShares 7 to 10 year treasury bonds. And this is a medium-term bond, and it has got more stability, and it has got less risk than long-term bonds. And then, of course, we have got AGG, iShares Core US Aggregate Bond ETF. And these consist of a hybrid between treasuries as well as corporate bonds. So if you have an inclination, go for that. And all of these things should be a choice from which you can draw for your investment in bonds in order to protect yourself from recession. Next, I want to turn to one of my favorite asset classes, which is gold and precious metals. GLD, SPDR gold shares is one of the ETFs I mentioned here. Personally, I've used ZGLD because that's in Canadian dollars. I'm based in Canada. But if you're in US, you could use GLD, you could use IAU, iShares Gold Trust ETFs. But when you're investing in gold ETF, if you want pure play, you have to look at the portfolio and see what companies are included in the portfolio. If there are gold mining companies in there, then it's not a pure play. A pure play will just have physical gold and it will hold only gold in it. If you have miners also included in it, it's not a pure play. So miners shares will have its own risks because the miner may stay solvent or insolvent, their operational efficiencies and other things, and also the place where they have the mine, whether it's a disturbed area or otherwise. All of those things can have an impact on the value of the ETF. Therefore, I personally prefer pure play gold ETF, where we are just looking at the physical gold being the underlying for the ETF. GLD is one of those, in my opinion, and it will do very well during market downturns. We have IAU, and you have SLV, which is for silver. Silver and gold go together. 20:1 ratio is what I think is ideal. 20 units of silver for 1 unit of gold is the way I would look at having an investment in precious metals. Another point to remember when you're investing in gold is that it's preferable to have physical gold. At least that's the way I look at it, because physical gold has got no counterparty risk. What is counterparty risk? Counterparty risk is when the value of your investment can be realized based on the performance of a promise by another party. In case of buying physical gold, you are just giving the money, taking the gold and putting it in your safe, and that's it. You have got your value, you paid the money, and you got the goods in your home. Whereas if you look at ETF, in ETF, they have a place where they store all the physical gold. There's a depository, and whoever runs the depository is responsible for providing security for the gold so that it's not stolen, and for taking care of the inventory to make sure it's all out there. Whatever was promised to be in the storage is still there. The same ounce of gold, the same purity is still there. All of those counterparty risks apply. So when I buy ETF, gold ETF, I'm getting a certificate that says that a certain amount of gold in that depository is assigned to me, and I own that gold. And it all depends on the performance of the depository. If the depository faces a huge burglary or something goes wrong, then that risk is still on me as the holder of the ETF. Therefore, I personally prefer physical gold, but gold and silver ETFs can be very convenient for a retail investor because you don't have to pay for the locker, and if you keep it at home, you don't have to worry about the security and all those things, because physical gold needs all that stuff. With ETF, it's all in your portfolio. It's in the it's on your computer. You just go in and you buy and sell at the click of a button, and it's a well-oiled market. It's very fast, and the liquidity is immediate. Whereas with physical gold, the liquidity may not be as easy as the ETF liquidity. So you will have to shop around to find the best price for your gold, and that also involves a certain amount of risk, carrying gold with you personally and selling it somewhere and taking the physical cash and putting it into your bank account. So keep all of those things in mind when you think about gold and precious metals. What is your choice? Next, I want to turn my attention to stagflation. Stagflation is a condition where you have got high inflation and high unemployment, both in tandem. Therefore, it's very difficult to control that kind of a situation. If the Fed was to increase the interest rate to control the inflation, more job losses may happen, more companies may shut down, they won't be able to service their debt, and the inflation could go up because the increased cost of interest is passed on to the consumer in terms of the price of the goods sold. So it's a very difficult situation. In case of a stagflation, XLE would do very well because it targets the oil and gas sector and has companies like ExxonMobil, Chevron. These all benefit from inflation. And then you have DBC, which is from Invesco. It has got a broad range of commodities that perform well during stagflation. It has got not only oil, but also metals and agricultural commodities, because these are all essentials that are needed for survival of human beings, regardless of whatever may be the situation. And then you have gold shares, GLD, which we spoke about in case of recession. That's applicable here as well. And GSC, iShares commodity index, which tracks energy, metals, and agricultural prices. It's broad commodities. These are the ones that you could also look at in order to diversify yourself for the eventuality of a stagflation. Next, let us look at the other asset class that will be good for stagflation. These are real assets, and we look at Vanguard Real Estate Fund ETF, or VNQ, and it holds real estate which continues to hold value as inflation rises. And I would just add a little bit of a caveat that you should keep in mind. It's not like real estate will preserve 100% of your value, but in the long run, real estate preserves more value. Gold preserves even more value. And the reason why real estate preserves a little less value than gold is basically because real estate value also depends on the cap rate and the affordability. As rents go up, people might find it difficult to pay as much of the rent. So there is a little bit of natural market cap on the rent, and therefore, as the in terms of rate of return, the purchase and sale price of such real estate also fluctuates along with that. In good times, when the economy is expanding and interest rates are going up, you can find that the real estate prices will go up, rents will go up, and everything will be hunky-dory. But when things change, it's difficult to sell the real estate, whereas with gold, you can sell scrapes of gold and get exactly the kind of money that you need instead of having to sell the whole thing. You can't do the same with real estate. However, ETFs provide you the opportunity to sell part of the portfolio. It gives you the scalability in response. Therefore, I prefer ETF for real estate as compared to physically holding an ETF during stagflation or recession, because you don't have the headache of dealing with tenants and other things and collecting the rents, overdue rents and repairs and all that stuff. ETF is the place to go. Then you have Wood, WOOD, which is iShares Global Timber and Forestry ETF. Hard asset like lumber appreciate with the inflation. And then you have PICK, iShares MSCI Global Metals and Mining Producers ETF, which contains a portfolio of inflation-resistant metal-producing companies and metals. So these are the ETFs that I was able to find out for hard assets. And next, I would like to talk about Treasury Inflation Protected Securities, or TIPS ETFs. So TIPS ETFs hold TIPS, or Treasury Inflation Protected Securities, and it adjusts for inflation unlike regular bonds. So it gives you that added protection, and that's especially helpful for a stagflationary situation. And then also we got VTIP, which is from Vanguard. It's also the same, but it's all short-term tips. And friends, I would like to remind you once again, if you have not seen part 1 of the video, which is recession, stagflation, where to invest, in that video, I have explained to you what is recession, what is stagflation, how does it feel when you are in a recession, how does it feel when you are in stagflation, and what are the problems that might occur due to these economic conditions. And part 2 is what we are doing right now when I'm talking about ETFs you can use to protect yourself against recession or stagflation. Having said that, I would like to summarize everything we have done so far. We have looked at both recession and stagflation, and we have identified ETFs for both recession situation and also for stagflation situation. So we said that in the defensive category, we would look at XLV and XLP and VPU for a recession, whereas for stagflation we are looking at XLE, which is energy, and VNQ, which is real estate. And in case of recession, we are looking at bonds like TLT, IEF, and AGG. Whereas for stagflation, we are looking at TIPS and VTIP ETFs. And then for recession, we are looking at commodities like gold and silver. Whereas for stagflation, we are looking at commodities like gold and silver, plus we are also looking at broad commodities like teak and those kind of commodities. And then we are also looking at dividend stocks like VIG, dividend ETFs like VIG for recession. And for stagflation, we are looking at energy and commodity dividend stocks, which are contained in ETFs. So I've given you a bunch of ETFs in the video. So this is a broad summary of what we have done so far. So I'm thinking, friends, we are more or less reasonably prepared for the event of both recession as well as stagflation. The only thing that I'm not yet clear about is how long or deep the recession or stagflation will be, because we have got heavy investments going on in AI. And I believe AI is a game changer because it's going to create disinflationary pressures. Cost of goods is going to go down, productivity is going to go up, and there'll be an industry churn. Many companies will lose their business, and some of them will become leaders in their business thanks to AI. And also intelligence is getting commoditized. So it's a very different environment in which we will be. So what does a retail investor do in such an environment? I'm working on exactly that video for the next one. So keep watching for it. I have a video coming up which talks about what a retail investor needs to know about AI and what the future is going to look like from a retail investor's point of view, and how we would succeed in investing for the future now and for a decade from now, because you're going to have physical AI, multimodal AI, and other kinds of AI deployed into business, and you want to protect your portfolio. With that, my friends, if you have not yet subscribed, please subscribe to ShareTech and become a valued member of our community and join this retail investor community that's trying to share information and make us all better investors. Thanks and have a great day. Bye for now.